Hello, my name is SteveJanz, and welcome. Today we're going to cover net present value, and this is a very important calculation to do in your BC1 case. You're going to solve these calculations in Excel, so I'm going to go over some of the techniques on how to solve this in Excel, as well as some of the theory of why we're calculating the numbers the way we are. So you have your question, Texas Tech, and they manufacture testing instruments for microcircuits. You've had a chance to work on it. You've had a chance to look at the solutions. Now I'm going to highlight some of the key elements of the solution in the question. Let's get started. Now remember, this is all in Excel, and that's how you're solving it. So the first thing we want to do is we want to take a look at the fact that when we're calculating value, we're dealing with relevant future cash flows. So this isn't GAAP accounting. This is about management accounting. And it's all about the relevant cash flows, and it's all about the future cash flows. And it's cash coming in, cash coming out. We're also going to consider the time value of money. So you're going to see that we have to calculate present value, future values, and payments in our calculation. First couple entries. It's going to cost us, if we decide to go with this pump, a minus $744,000. That's cash going out. Now, if we sell the old pump, we'll receive a positive $40,000 coming back into the company. Now, if we go with the new pump, we're told we'll be able to sell it 4 years from now at $96,000. What we have to recognize is that $96,000 is not the answer here, because we're not going to receive that money for 4 years. So what we have to do is we have to take and we have to calculate that. Now, in class, I will show you how to do this on a calculator so you can handle it on a test. In Excel, you can actually type in the information into a formula, and it will calculate it for you. So what I want you to do is I want you to go equal sign into that cell and go negative PV. And what it's going to do is it's going to have the abbreviations and what everything stands for coming up. You're going to see rate, end periods, payment, future value, and type. So what you're going to put in here for the first one is you're going to put 0.16 comma, and that is the rate. You're then going to put in 4, which represents the 4 years from now that you're going to receive the money. You're going to put 0 in here for the payment, because there is no payments here. This is just a future value. And then the future value, which is your fourth entry here, will be $96,000. You will put in $96,000. And don't put in a comma here. Just put in $96,000. And then the last item here that you'll enter will be a 0. And 0 represents the type. And 0 is an end of the period, or if it's 1, beginning of the period. But for the most part, we're going to always put in 0 for these net present value calculations for the most of the time. And if you type that in, what you should hopefully get is $53,020 coming up. And that represents the positive amount of cash flow you'll receive 4 years from now, discounted at the rate of 16%. So that's why you're going to get $53,020. Again, you can do that on your calculator, and I've given you the steps to do that as well. Now, one of the things when you are creating this schedule, and I want you to create this schedule, is if you notice on my solution that all over here on the right side, I've got the data. Everything in my schedule here is actually a formula. Nothing in here I'm putting in. And over here is the data, and everything from the schedule ties into the data. And therefore, if the data ever changes, you just update your data, and instantly your schedule will be updated. That's the beauty of an Excel spreadsheet. And that's why we spend so much time in all the classes you're in with me on Excel. It's just so beneficial. And in work, you use Excel all the time. Let's carry on with our next couple calculations here. What you can see here in our next couple calculations is that we're going to take a look at the tax shield and the lost tax shields from this investment. When we make investments into capital projects like this, we are allowed to use that investment amount to help us reduce our taxes. So there's a tax benefit to making these capital investments. So we've got those two big formulas you'll see on the question there, and you see those in the case. We put the information in there, and it comes up with our values here, our beneficial values. So let's talk about the first one, the tax shield value. When you create this formula, you're going to get an answer of 159,865, a positive number. And that positive number is great. That's what companies want to achieve. The tricky area and the tricky calculation there is that it's the calculation of your cost. A lot of people will say that the C is equal to 744,000. That's wrong. It's the net amount that you actually have to spend because it's what goes into the pool of assets. So you're going to spend 744,000, but you're going to receive 40,000 back from the sale of the old pump. So your cost then, your net cost, is 704,000. So that's the tricky area. You have to pay close attention to the 704. That is the correct amount. Now, our next number here is the lost tax shield. Because we're going to be able to sell our pump at the end of 4 years, we're not allowed the full benefit of this. We have to take and consider that we're going to lose some of our tax shield because we're going to be able to sell our old pump. And notice that it's a negative value. Now let's talk about the last two important calculations. You'll see here that we've got a recurring savings. Now the recurring savings equals 180,000. But I have 108,000 here. The key thing to recognize with any additional revenues or any additional expenses or any expense savings is that everything must be taken as an after-tax value. These first three calculations here, this isn't involving tax. This isn't revenue. This isn't expenses. So there's no after-tax here. But these calculations down here, they involve tax. And if you take a look at the question, it says that our after-tax required rate of return is 16%. So it's key for us to focus on the word after-tax and make sure that our required rate of return is an after-tax percentage. And then to be consistent, we want to make sure that all our values, anything that affects the revenue or the expenses, are considered to be after-tax. So that's why you see this at 108,000. If you actually take a look at the calculation for this, it's 180,000 times 1 minus the tax rate of 40%. So the after-tax rate is actually 60%. That's how you get 108,000. So that's very key to remember, after tax for these revenue and expense items. The next calculation we have to do is that we're going to save this value for 4 consecutive years. And when we do our calculation, it's 302,204. The key thing to remember here is that this isn't a future value that we're looking for. This is the payment amount. So when we are looking and doing this calculation, we're going to do this from a payment perspective. So if you were to enter in this value here, and you are entering it in, basically, to take a look at how we were going to do it, you would have to use the payment feature that you see right here. So you would go negative present value equal to 0.16 and 4, but then your payment amount would be the 108,000. Your future value would be 0, and your type would also be 0 as well. The last calculation is our additional manufacturing. This pump is going to allow us to manufacture additional units. And you can see in the schedule in the solution that we're going to have 30 units, 50 units, 50 units, and 70 units, those additional units over the next 4 years. And again, pay attention to the fact that it's cash that we're calculating, that it has to be calculated after tax, and that we're going to calculate the present value of each of these separately because they're different values. The total comes up to $110,715 as a present value amount. Now, one of the little trickier areas in this calculation is the following. You're told that you have selling price equal to $4,200. And your cost of goods sold is currently $2,940. You're going to be able to save $120 with this new pump. So therefore, your cost of goods sold will be now $2,820. So it's important to recognize that your additional cash inflow will be $1,380 per unit. And that's very important to recognize. And again, that is, in a lot of ways, our profit. But in net present value, we like to think of it as the additional cash inflow. Because net present value is all about analyzing cash going in and cash going out. So in this case, you can see that the final answer is minus $91,128, which is a negative net present value. So the company, if they were strictly going to focus on net present value alone, would not choose to do this. I hope this question helps you and helps you understand how to do the present value calculations, how to set up your Excel, and the importance of using Excel. And make sure you follow a very similar method that I've used in the solution here. Thank you. Have a good day.